If you were going to travel from New York City to San Francisco, there are such good road signs and highway systems across the United States that you could probably find your way without having a detailed roadmap that outlined your journey. But doing so wouldn't make much sense, would it? You would end up taking a few wrong turns, you'd have trouble getting started, and ultimately you would be sure to get lost a few times along the way. The same is true for choosing to invest in business. Having a clear idea of the benefits and advantages of different types of real estate deals, clearly evaluating where you are in terms of resources, and moving in the right direction with the least amount of wasted time will be a tremendous asset to you. One of the first things you should do is a personal financial evaluation of where you are at this moment in time. Do you have strong or weak credit? Do you have access to money lending sources? Are there public institutions, lenders or banks, or private contacts who might be willing to help you get started? Once you have clearly delineated your current position, you are able to begin choosing the right types of deals to move you towards financial freedom. For example, if you have few financial or credit resources, you will want to choose the types of real estate deals that do not rely on either credit or funding. One of these types of deals is called wholesaling. Now, real estate investing is attractive because there are many types of ways to invest in, or many types of property types to invest in, as well as many strategies for what to do with those properties. And each comes with its own rewards. Here's a few examples of the main types of investment opportunities with their primary benefits listed. So the first is wholesale, which is buying and also doing contract sales. The benefit of wholesaling investments is that there's typically a quick cash return and a low cash investment. This is a great investment strategy for people with low funds that they're starting with, not a lot of access to lending sources, and any beginner who is looking to start off without taking on a large amount of risk. Another investment technique is the lease option. The benefit of a lease option or investing to lease through real estate is that it provides a positive cash flow. It provides an appreciation and can be structured with typically a low cash investment. And so this will provide real estate investors positive monthly cash flow without typically having a lot of cash down involved, especially if this is someone's second, third, or 15th property. Another technique or circumstance would be a foreclosure. This typically provides real estate investors quick cash in the short term, and while it does require some cash to purchase a foreclosure, it can still yield a very positive return. Another technique would be rehabbing. This would be buying a distressed property that needs some cosmetic or just internal rehabilitation. And this provides quick cash or cash flow if you're going to lease it afterwards, but it does need cash or credit investment. Another one is mobile homes. This is a great investment technique for real estate investors. It provides great cash flow and typically has a low cash investment. Tax liens and deeds. This here would be considered portfolio income, typically from interest. It does require a higher cash investment, but it only has a little bit of leverage, and we'll talk more about this in later videos. And then another real estate investment strategy would just be property management or managing other investors' property. This provides great positive cash flow with very low cash investment needed to begin. So let's continue going over more of these. Investors consider different options based on the outcome they want to achieve, the amount of cash they want to invest in the project, and their level of experience with different strategies. For example, an investor may want to consider quick cash investment strategies for a variety of reasons, including high consumer debt, which would generate quick cash to pay down that debt, or lack of seed capital to work with. This would allow them to use wholesale opportunities to quickly build more money for future investments. Of course, with multiple income streams and opportunities comes the need to obtain the proper knowledge to specialize in different areas. And so you might be wondering how to choose your streams of income now that we've quickly defined a few real estate investment opportunities, and you want to figure out which factors should influence your decision. So before we go any deeper, let's take some time to define the various types of income and the benefits of choosing one over the other. So the first type of income in real estate investing would be earned income streams. These would include wholesaling, purchasing foreclosures, pre-foreclosures or real estate owned properties, also known as post-foreclosures, rehabbing, probate, discount note selling, remodeling, and land development. Basically, anything that you are going to contract and sell quickly that would fall, this would just fall into the earned income category. The next type of income through real estate would be passive income. This is what most people get into real estate to achieve. Passive income is money that comes to you week after week or month after month without you going out and doing another deal. This type of income is also sometimes called reoccurring income. In real estate, these would be your buy and hold properties, your rentals and leases. Once you have closed on these deals, you collect the rent, or your property manager collects it for you every single month. Another real estate related field of income that would be considered passive is when you become a property manager or have a property management company, and investors hire you to collect the rents for them and pay you a fee to do it. And so quickly, I'm going to just run through the types of passive income streams for your reference. And so the first of which, the obvious, is rentals, renting out houses, apartments, mobile homes. There's leases, which is lease option properties, property management, recreational parks where you rent out spaces, mobile home parks where you rent out lots and others own the mobile homes, apartment houses, which bring you in multiple payments every month. This could be things such as Airbnb, and then commercial spaces, offices, retail established, storage unit facilities, industrial buildings. Buy and hold properties are where you build long-term wealth and begin to benefit from appreciation and tax advantages. So earned income streams help you generate the cash to move towards buy and hold long-term wealth. The two work hand in hand to help you achieve your goals. The other source of income in real estate is called portfolio income. Portfolio income is when your money begins to make money for you, typically through interest. Let's say you have $30,000 to invest in some type of real estate related deal, but you do not want to have to do any work or invest any time once you have made your purchase. In this situation, you might choose to invest that money in a tax liens that earn a return of 18% per year. You attend the tax lien auction, purchase liens that take the $30,000 investment amount, and then you sit back and wait for them to be redeemed. Your money begins earning interest at the rate of 18% per year the day you pay for the liens, and the county property tax office employee does all the monitoring and paperwork. That sure beats investing in a CD at 1% to 2%, right? Now, there are several other ways for you to generate portfolio income that is real estate related as well. Most of these streams of income relate to the investor earning interest on his or her money. And while we're not going to go into depth on these techniques, it is important for you to at least understand the potential and definition of these income streams. So again, a few types of portfolio income streams: tax lien auction investments, discount note buying, seller financing, hard money lending, and venture capital. In real estate, you will hear these three types of income streams referred to as the circle of wealth. Real estate can allow investors to create wealth through a very systematic process that builds upon itself. While everyone is different with different goals and demands on their times, professional real estate investors will typically want to have 3 to 5 streams of earned income, 3 to 5 streams of passive income, and 2 to 3 streams of portfolio income. Now, new investors who have a limited amount of money begin to become knowledgeable in a few earned income streams, such as wholesale, foreclosure, and rehabbing. Now they have more control over their ability to generate large amounts of cash in a short period of time. They then take that money and begin to invest in buy and hold properties such as lease option houses. They have now learned to invest safely. And once we learn to do it safely, we can do it quickly. As the passive income grows or the lease option properties begin to sell, usually within 1 to 3 years, the investor has two choices: either buy another buy and hold property, or invest in a portfolio stream, such as a tax lien, as we talked about. And so it's important that as a real estate investor, you begin to train your mind to think in terms of the circle of wealth, and always ask yourself what your short and long-term goals are at any given moment. Yes, we get rich in buy and hold situations, so that is your ultimate goal. But if you are beginning with limited resources and need to generate some cash so you can build a substantial portfolio in a fairly modest number of years, earned income can help you do just that. Now, an important consideration is that as investors, it's crucial for us to begin with the end in mind. Now, I realize you might be starting on a shoestring, or you probably have immediate needs that you want real estate to assist you in fulfilling. However, this business can be one of the best ways for you to become a millionaire or multimillionaire. And on some level, you understand or you wouldn't be watching this video. So set aside your fear and discouragement from yesterday and ask yourself, if I could retire in 10 years and own and control 350 apartments in a good neighborhood that produced $25,000 a month in positive cash flow, would I feel safe and secure about my financial future in my golden years? I believe that most of you would answer this question with a resounding yes. So let's begin your investing business with that level of commitment to your future. And the circle of wealth can help you achieve those goals. Now, consider it carefully and ask yourself what it could mean to your current lifestyle if you had 7 to 10 streams of income and could generate both short and long-term cash flow. And now, once you've thought about that, commit to your future and acquire the knowledge and find a mentor to guide you along the way. Now, before we dive any deeper into these subjects, let's take a quick moment to discuss some of the key property investment types in overview, just to form and familiarize you with some of your options and prepare you for what you're about to learn from this material. So, as you're making the right income stream choices, there's an old maxim when it comes to real estate investing. There are only 2 types of deals out there: either distressed properties or distressed sellers. Regardless of your investment strategy or targeted property type, you will find that some properties provide more ideal investment opportunities than others. And when we refer to a property as ideal, we do so for a reason. The word is also an acronym for the following. I equals income, which produces cash flow. D, which equals depreciable, which offers tax advantages. E equals equity buildup, increases your net worth. A equals appreciation, which increases in value. And L equals leverage, which increases return on your investment. As professional investors, we should be weighing each deal against the ideal and then consider the benefits of that type of deal versus another opportunity. We don't always hit each one of these characteristics, particularly in the beginning of our investment careers, but we always evaluate and make informed choices. When considering a distressed property, we're looking for the following advantages. There's often less competition for them since the average individual wants properties in good condition. Most market areas offer numerous distressed properties to choose from. You can often purchase distressed properties under flexible, easy terms and for prices substantially below market value, making for a nice profit margin on a resale or good cash flow on a rental. You also will have the ability to instantly increase your property's value through minor improvements and rehab work, as we talked about, which would be the forced appreciation. Some things to think about with distressed properties include most real estate markets have a sizable number of investors looking for these types of properties, so your marketing efforts need to be active, well-planned, and effective to find good deals. It would be wise to investigate different marketing strategies that have worked well for other real estate investors and to find others in the business that are willing to teach you where to look for opportunities and provide tips on how to bring opportunities to you. Now, to avoid costly mistakes, you'll need to know how to effectively evaluate the property in its neighborhood. You'll have to have thorough inspections and repair estimates that should be performed prior to any purchase. And if the property is in a lower income or an older neighborhood, the comparable sales in that area will not go over a certain amount of money, no matter how much improvement is made. Repairs are often costly, so in order to maximize profitability in the older, lower income areas, it is typically safer to combine a distressed property with a distressed seller and maximize the profit potential on each aspect. Now, the advantages of working with distressed sellers is that the sellers there's seller distress in every price range. You can sometimes purchase properties under flexible and easy terms, and the seller needs help, and in many cases just needs a way out, but does not know what to do. And so you can provide that solution. Seller distress is often caused by property distress, so the chances of being able to increase property value through cosmetic improvements or rehabbing when you can match a distressed seller with a distressed property are excellent. Now, things to think about with distressed sellers include seller distress must be handled delicately. These sellers are going through rough personal, professional, or financial times, and they can be experiencing all kinds of emotions. You must know what put the seller in the situation they are currently in and figure out the best way to help them get out of it. In order to understand their problem and solve it, you will need to develop good listening and negotiating skills. Some distressed sellers present compelling reasons why they want to stay in their properties, and the tendency is to want to accommodate this. Now, if their challenge is for financial reasons, this can be risky. It is important to keep your emotions out of it. The distressed properties, now let's just talk about wholesale buying. Distressed properties make for great wholesaling candidates, and wholesaling is an excellent opportunity because it requires little expertise and typifies the quick cash type of deal that many beginning investors are looking for. Wholesale deals may be one of the first type of deals you will make in real estate investing because it's easy to identify distressed properties, and there's such great potential for quick cash. To truly be successful with wholesaling, some of the things you will need to learn include how to properly segment your market, develop a database of potential properties, investors, and buyers, understand the multiple ways to target and market for wholesale deals, locate absentee owners, build a network with other investors, and develop key strategies that will help you close deals. In addition, you should master several basic aspects of the wholesaling business, including pre-screening prospects. Since distressed properties should be your primary target, you should learn how to both identify and evaluate distressed properties. You should also understand that a distressed property does not necessarily mean a deal is good, but that it is a good start. You need to master the techniques to know when a deal is too good to be true, when it's time to move forward, and when the deal needs to be left on the table. It will also help to know how to identify a motivated seller, because the combination of a motivated seller and a distressed property will make this opportunity far more advantageous. You'll also need to learn how to determine market value. You need to understand the importance of determining fair market value after repairs to be a successful wholesaler. The real estate professionals on your power team will be key assets for getting this information. Also, using comparable sales of homes in the same market area will help you determine fair market value. Another important aspect of wholesaling is estimating repairs. This won't be a successful venture if you do not estimate repairs correctly. You'll need to learn how to analyze deals to ensure you make an offer that will result in the most profit. There are also strategies you can learn that will save your money or save you money on rehab projects and maximize your profits. Now, in wholesaling, making offers and counteroffers, you'll need to become familiar with good negotiating and communication skills, learn how to make offers and counteroffers effectively without compromising your goals, and learn how to work with contracts. Knowing how to properly evaluate properties will be critical to determining not only what to offer, but if you should make an offer at all. And when you're lining up buyers, wholesaling is actually only partially complete if you can find and negotiate deals, but you have nobody lined up to readily assign contracts to. Building a sizable investor database to tap regardless of the type of deal you are working on will help you move things forward quickly and preserve your profit margins. And again, these would be real estate investors who have the cash but don't have the time to devote into finding the deals that you've now found. Another thing that you'll need to be aware of in wholesaling is being able to close effectively. You need to learn the strategies necessary to close without cash, including how to do contract assignments and simultaneous closings. Moving on, so talking quickly about lease options. Lease options represent one of the most attractive real estate investment opportunities for both new and experienced investors, particularly because they can generate multiple streams of income within a single deal. The following offers a few general points about using lease options to invest in real estate. Now, if you buy property with a lease option, you can gain control of a property without taking ownership of the property. You have no obligation to buy, but you have established the right to buy. You'll typically work with distressed sellers, not with distressed properties. Seller circumstances create the deal. What you need to do is find the problem owners. You'll also live in or control nice homes in nice areas. In these cases, the seller needs to get out and the investors want to get in, and which creates an excellent match. And desirable neighborhoods create demand. Now, when you help someone else, or through lease options, you end up helping someone else in many cases. The determining factor in lease options is often debt relief. You are usually working with people who may not necessarily want to sell their property, but who must sell it because of the financial problems. You can help someone else reach a solution quickly. Meanwhile, you can do it with little or no money out of pocket. And if you sell the property with a lease option, you can benefit from a large market of motivated buyers. Lease options can be very attractive to people who are just starting out or who are starting over. And lease options may be the only option available to some people based on their credit circumstances. In addition to all this, you'll be able to find multiple profit centers through lease options. You can create positive monthly cash flow for yourself, collect a non-refundable option consideration, and profit from the difference between what you paid for the property and what price you set for the tenant or the buyer. Other than lease options, we have foreclosures. The foreclosure market can also provide a great avenue for profit for the beginning to experienced investor. Foreclosures, while unfortunate, are an everyday occurrence, and this can be your opportunity to not only make a wise investment, but also to help someone else in need. Remember that foreclosures can happen for any number of reasons, and this is an area where you can really create a win-win situation and do something that benefits both you and the person you might be who might be in trouble. And investors must be able to effectively negotiate with both lenders and homeowners to optimize profits on these deals. So, in summary, it's a learning process with so many strategies to employ and ways to make money in real estate. Knowledge will be key to your success.